Hello and welcome to Traders Corner. I'm Bronwyn Seaborn, and with me at the desk is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks for your time today.
Thanks. Hi, Bronwyn.
So the S&P 500 has broken down rather significantly. It's risk aversion. You know, a lot of people worried about US-China trade concerns, and we're really seeing that filter through onto the S&P 500. So let's take a look at the chart.
Yes, we're going to look at a couple of US factors at the top of the show here. So the S&P 500 weekly chart is what we're looking at here, first of all. And you can see quite clearly that upward trend that has been intact since early 2016 and was a nice, well-defined, well-fitting upward trend has been broken quite convincingly to the downside. The break below 2,800 on that index was a bearish break. We've subsequently had a throwback to test the underside of that prior upward trend line, which now offers resistance on a move higher, and the market has subsequently begun to turn lower again. The lateral support area that I've indicated there is at around about 2,600, and that was more or less the lows that we saw in the first quarter of this year, give or take a little bit of noise, and it was the low that we saw in October now recently. But if we have a look at the daily chart, here you can see it more clearly. There's that lateral support zone at 2,600 that I was talking about, and you can see it how it was met during the first quarter of this year. Again now at the end of October, and the market has been moving lower over the last couple of sessions, and we can't rule out the possibility that we perhaps go back down towards that 2,600 area again before finding a little bit of support. So overall, you know, what it tells me is that this bull market that we've been in for the last 9 years on the US markets is looking a little bit precarious now. It's very aged. There's risks on the horizon. You talked about trade wars. We've also got rising interest rates in the US. There's a lot of risks mounting on the horizon, and I think the equity markets are starting to reflect those risks. Also, if we take a look at the NASDAQ, this is obviously the very tech-heavy index, so this is where you typically find your FANG stocks, your Facebook, Apple, Amazon, Netflix, Google, and the like. And those are the stocks, the big tech stocks, the big growth stocks that have really driven this bull market over the last number of years. And we've actually seen those stocks beginning to falter over the last month or so, quite badly. I mean, some of those stocks, like an Amazon, for example, is down 25% off its peak. So that's significant. And we're seeing a lot of those similar tech stocks that seems as if some air is now coming out of that bubble. And it's being very much reflected in the NASDAQ. Just in terms of the support level to watch on the NASDAQ, there's lateral support at about 6,400. As we sit here right now, the NASDAQ futures are actually trading below the October low. So it's a possibility that we could see this market fall into that lateral support zone at about 6,400 before it maybe finds a little bit of buying interest.
But it's not to say that it's all bad news, because you have identified some stocks, defensive stocks, that are offering some opportunity at the moment. So tell us which ones those are.
Yes, well, I just thought this was interesting to note, and I'm not sure that too many local commentators have picked up on this. But if you look in the US, it seems there's a big discrepancy now happening between your defensive stocks, your sort of old school, old economy, old world stocks, and your what were the growth stocks, primarily the tech stocks. So if you have a look here, for example, this is Johnson & Johnson, probably a company that doesn't need much introduction. And look how strong that chart has been over the last 6 months or so. It's clear that whilst the tech stocks, the Apples and the Amazons and the Facebooks of the world are all coming under a lot of pressure, it's pretty clear that these types of stocks are now attracting money. And this is quite interesting to note, because you do find this type of shift and this type of sector rotation happening at the end of a bull market, where your growth stocks are now giving up the lead in favor of your defensive stocks. So that's Johnson & Johnson. Another one to look at here is Coca-Cola, of course, another company that needs no introduction whatsoever. Look how strong that chart is looking. And the last one that I've got here is McDonald's, another company that, of course, needs no introduction. And look how strong that chart is. And there's always a theory around McDonald's that they actually do well in a slowing economic environment, funnily enough, because people tend to shop down and go to McDonald's for their eating out as opposed to smarter restaurants. So it's a very counter-cyclical stock. So I just think this is worth noting and paying attention to, because these kind of stocks doing well is very symptomatic of an economy that is probably rolling over in the US.
Great. So then let's come back home because, you talk about the tech stock sell-off, and along with that is Tencent, which then impacts Naspers, which then impacts our overall market. So let's take a look at the top 40 future and what that is indicating to us right now.
Yes. So it's had a bad week overall. It's a bit weaker today as we sit here right now. Look, the big resistance level is still that 49,000 area that we've discussed many times on recent shows. That was support throughout the early part of this year and into the third quarter even. The break below 49,000 that occurred in October was a very bearish break. We then had a throwback to the underside of that. What was support now becomes resistance, and you can see how the market has now turned back to the downside. As things stand right now, I would say there's a fair possibility that we may go back and revisit those October lows as things stand right now, which is at about between 44,000 and 44,500. And as you alluded to, Naspers is, of course, a very big component in our index. And if that stock comes under pressure, the top 40 comes under pressure. And that's exactly what we are seeing here at the moment.
So then given that lackluster performance that we're seeing, you did have your eye on Netcare and you initiated a trade last week. So let's revisit that because we were stopped out, but maybe a little bit disappointing because it has kind of come back.
It's very disappointing, actually, because this is the second time we've had this type of situation happen to us recently. So we had it on Capitec recently where it traded lower. We executed a stop loss only to then see it rally and do exactly what we expected it was going to do in the first place. And we weren't on board for that rally. So it happens in trading. But it's now happened again with Netcare, which is, again, unfortunate and a little bit frustrating. So here we have the daily chart of Netcare that I spoke about last week. And the thing about this stock is that it tends to trade in these sideways bands. And it does this quite often. And you can actually identify a 4 or 5% trading range in Netcare, which often sticks around for weeks and weeks at a time. And you can trade that range quite actively if you're astute and you're watching it carefully. It had a range between 23.50 and 24.70 through October. And early November now it broke out. And it looked to me as if it was starting to track a new range between 24.70 up to 26 Rand. And I looked at that and I thought, well, cool, let's take advantage of this trading range. Let's buy it off the lower end of that range and try and trade inside that 5% trading band. Now, if we zoom in and have a look at the hourly chart, this is what I also spoke about last week. I identified this range, which is between 24.70 and 26 Rand. And you can see that we went long off the bottom of that range last week. After it had tested 24.70 and moved up, I went long at 25 Rand per share with a stop loss at 24.50, and we were looking for a move up to 26. Now, as you can see, it had a brief blip below the 24.70 area. It triggered our stop loss at 24.50. It traded as low as 24 Rand. And then what happened earlier this week, or yesterday in fact, was the company came out with an announcement that they would be doing a share buyback.
Yeah.
And that Netcare was up 5% on the day. And of course, now you can see it's gone to the 26 Rand area, which is exactly where we would have wanted to bank profits. Unfortunately, we weren't on the bus for that move up to 26 Rand. We were stopped out already. So we lost 2,316 Rand there. It's unfortunate, it's frustrating, but it is what it is. And sometimes in trading that does happen, and you've kind of got don't let these things get to you too much.
Because doesn't it, in the frustration, make you think maybe you should change your strategy at all? How do you really deal with that in a trading environment? Because I know we speak about it again and again. You've got to stick to your plan. But surely when things happen like this, you think, oh, maybe I must just tweak it a little.
Yeah, it's frustrating. Because, to see that you were just briefly stopped out and that it went up to your target ultimately. But the thing is, we've been doing this show for a long time, and we've always been very vigilant about sticking to our stop losses and making sure we don't lose too much, so that when we are wrong, we lose a little bit of money, and when we're right, we try and make as much as possible. And by and large, that's a sound strategy, and it's worked well for us over the 9 years that we've been doing this show. So I stick with that, and I say, look, it's unfortunate. And it's going to happen sometimes, but it's more the exception than the rule. In most cases where we've executed a stop loss, I've been very, very glad that we did execute the stop loss, because things have gotten worse thereafter. So if we have one or two situations like this, as long as it's not happening all the time, I'm quite happy to brush it aside, put it behind us, and just look forward and find the next trade.
So looking forward and finding the next trade, we're not initiating anything this week, but you are keeping an eye on Mr. Price. You're saying that is kind of outperforming the pack. So let's take a look at the chart and tell us why you're seeing what you're seeing in Mr. Price.
Yes, Mr. Price has been holding up very well in what has otherwise been a fairly weak market over the last month or so. And you can see on this chart over here that there is clearly a pattern of higher lows that has been building since early September. And that's notwithstanding the significant weakness that we saw during the overall market during October. Also, if you look at it on a relative basis versus the rest of the retailers, this stock is also outperforming. So it's outperforming the market, it's outperforming its sector, and on its own relative merits, it actually looks pretty good as well. You can also see that your 50-day moving average, which is that blue line through the chart over there, that's actually beginning to take a positive slope now. And what is evident over the last month or so is that each time the price has dipped below the 50-day moving average and it's dipped towards this upward trend, it has found buying interest at the lower levels. So my expectation is that if it does do that again, if it dips below the 50-day moving average, it flushes through there, perhaps goes and challenges this rising trend, which comes in at around about, it's between 220 and 225, that sort of region. If we see some buying evidence in that area, then I think it's a fairly low risk buy in that zone. And I would then look to buy it for a rally potentially into the year end. So we're going to be watching this in the week ahead. I'm not initiating a trade right now, but it certainly is on my radar as something to watch between now and next week.
Okay, so we'll be keeping an eye on Mr. Price, but let's check in on the portfolios and look specifically at the local portfolio to see what kind of damage we had to shoulder as a result of that one trade.
Yes, fortunately the damage wasn't too bad. It's the Netcare trade where we lost 2,300 Rand. So we are still up 27% for the year to date. At our peak recently, we've been up as much as 29%. So we're slightly down from our peak, but still nevertheless a good performance in what has been a pretty tough year in the market overall.
Yeah.
And those are some of the other trades that we've had on recently, the Capitec we talked about, and Pioneer and Zeda we had on a few weeks ago as a pairs trade. Our offshore portfolio is totally unchanged from last week. It's still up 11.7% for the year to date. We've got no trades open there at this stage. That also is outperforming the broader international market complex at the moment. So I'm still happy with that. So, we're rapidly approaching the end of the year. We've only got a couple of shows left of this year, and I'm not sure how many more trades we'll be doing this year. But as things stand right now, it's looking to have been a pretty good year, notwithstanding a very torrid market environment.
Absolutely, you can't deny that the portfolios are up quite nicely. And then before we end off, just remind us how viewers can subscribe to your free weekly email as well.
Yes, if you go to traderscorner.co.za, you go to the middle of the page and you'll see there's a link there for a free weekly email. If you click on that, you can enter your details. It takes only about 30 seconds of your time, and then we'll send you an email every Tuesday detailing what is coming up on the show for that week.
Garth, like you say, not long to go, so we'll have to see what next week brings for us. Thanks so much for your time today.
Thank you.
Garth McKenzie is editor and founder of Traders Corner.